When you're buying a house, you should have all your options. You should know how much you qualify for and which loan program. That's the most important thing, right? And I want to go over different loan programs to educate you, and then you make your decision if it's a good loan program or not. The first one is bank statement loan program. Not a lot of people know this. You don't have to provide your tax returns. Rather, you can provide 24 months or 12 months of your bank statements. This could be your personal or business, and we can see how much money was deposited into your bank account and qualify you based on that. One of the requirements is that you need credit scores of 700 and you do need 20% down payment. You can live in this property or you can rent this out right from day one. The second loan option, you have DSCR. This is your debt service coverage ratio. We're not looking at your tax returns. We're not looking at your bank statements. We're only looking at the property that you're purchasing. It is for investors only. That means you cannot live in that property. Same guidelines, 700 credit scores and 20% down payment. But how do we qualify you on that property? That depends on how much rental income is coming in to that property. So if the rent is going to be $5,000 for that property, let's say it's 2 units and your mortgage is $5,000, then you can purchase that property, okay? The next one is going to be your commercial loan. This is obviously for investors only. You probably need to finance for a building, expand your business, right, for equipment, or need working capital. Then you probably want to go with a commercial loan, similar guidelines there, right? For first-time home buyers, right, for second, if you're buying your second home, or for investors, majority of the loans that we provide, they are done through conventional. Why is that? One is your credit scores. You just need 620 or more. You can put down as low as 5%, right? If you're buying 1 unit and you're going to live there. You can put down 15%, but if you're buying 2 units and if you need 3 or 4 more units, then it's going to be 20%. On the other hand, if you're investment, right, this is going to be an investment property, then you do need 20% for 1 unit and 25% for 2 units or more. But this is a great loan program. Why? One is your mortgage insurance does get removed even if you put down 5% once you hit 20% equity, right? Majority of the people use this loan program. Who doesn't know about FHA? Every first-time home buyer comes to our office and says, hey, I want FHA loan because the interest rates are lower. And then we educate them that, hey, on FHA, the good thing is that you can purchase a house if you have credit scores of 580 or more, and you can put down 3.5% down payment. But there's an upfront cost of 1.75%, and your mortgage insurance is never going away if you're putting down 3.5%. Anything less than 10%, your mortgage insurance is going to be there for life of the loan, right? If you happen to pay 10% or more, then your mortgage insurance gets removed after 11 years, right? So these two things play a big factor, so you should know about this. People who come in for FHA, we usually tell them there's a loan program called Home Ready and Home Possible, where you can put down lower than 3.5%. You can put down as low as 3%, but you do need credit scores of 620. This is a conventional loan, and there's another guideline is that your area median income matters. So if you're making below 80% of your area median income, then you can purchase this loan, right? So a lot of people come with this FHA and they end up with Home Ready as a conventional loan. So if you want to go through any of these loan programs in details and see which one is a right fit for you, please get in touch.